Welcome to the deep dive.
Hello?
Today, we're taking a close look at the Indian Hotels Company Ltd, IHCL. Specifically, their financial results for Q4 and the full year ending March 31st, 2025.
Right. And we've got the official filings, the press release, even the earnings call recording. So quite a bit of material to work through.
Definitely. Our mission here is to really pull out the key insights, the main figures, give you a clear picture of how they're doing and, where they might be headed.
Exactly. We'll hit both standalone and consolidated results. Dividends, revenue, EBITDA, that's earnings before interest, taxes, depreciation, amortization, PAT, profit after tax.
All the key stuff.
Yeah, and also hotel openings, signings, how the different business bits are doing, and importantly, what management's saying about trends and strategy from that earnings call.
And for you, the learner, the benefit is getting all this distilled, saving you the time of sifting through everything yourself. We'll flag the interesting bits, the surprises.
Hopefully spark a few aha moments along the way.
Let's hope so. Okay, let's get into it. Starting with the big picture. Overall consolidated financial performance. And wow, straight off the bat, a record performance for the 12th quarter in a row.
That's right. 12 consecutive quarters. It's quite a run.
That level of consistency really says something.
It does. And the numbers, well, they back it up. Full financial year consolidated revenue.
Yeah.
8,565 crores. That's up 23% from the previous year.
23%. That's significant growth, way above a, general economic growth.
Absolutely. It suggests they're really capturing market share. Could be strong demand, could be pricing power, likely a mix.
And Q4 specifically?
Q4 revenue was 2,487 crores. Also very strong, up 27% year on year.
Okay, so top line looks great, but are they managing costs well? How's
Yeah.
the profitability stacking up?
Seemed like it, yeah. Consolidated EBITDA for the full year hit 3,000 crores. That's a 28% jump.
Okay.
And for Q4, EBITDA was 918 crores, up 30%.
So profits growing even faster than revenue in Q4. What about the margins?
Good point. The EBITDA margin, basically, how much profit they make per rupee of revenue before those other costs had expanded.
Sure.
Up 1.4 percentage points for the full year,
Nice.
and 0.8 percentage points just in Q4. So yeah, they're not just growing, they seem to be getting more efficient while doing it. Could be operations, could be pricing, like you said.
Right. And the bottom line, the actual profit after tax, PAT.
Also looking very healthy. Full year consolidated PT hit 1,908 crores. That's a huge 52% increase year on year.
52%. Wow.
Yeah, and Q4 PT was 522 crores, up 25%. Now, it's worth mentioning, if you strip out some one-off items, what they call exceptional items,
Right.
the underlying profit growth is still solid. Full year PT before exceptionals was 1,603 crores, up 27%, and Q4 was 525 crores. Still very strong.
So what were the main things pushing these numbers up? What are the key drivers here?
Well, the sources point to a few things. First, strong performance from their existing hotels, what they call same-store performance.
Yeah.
So good demand, good occupancy there.
Okay.
Second, their new businesses segment. That saw a really big jump, 40% revenue growth. So those newer ventures are starting to contribute significantly.
First time? Okay.
And third, they mentioned not like-for-like growth. That mostly means including results from new acquisitions like Tree of Life and fully consolidating Tosh ads. So you just need to keep that in mind when comparing year on year. It's not purely organic growth of the core.
Got it. Makes sense. And shareholders are seeing some benefit too, right? Looks like the dividend is up.
Yes, exactly. The board recommended a dividend of 2.25 per share. That's a 225% payout on the face value.
Which is up from last year.
It is, up from 1.75 per share. It works out to about 20% of their consolidated POSH at. Shows confidence, I think, and a commitment to returning value, though of course it still needs shareholder approval at the AGM.
Right, standard procedure. Okay, let's maybe narrow the focus a bit. What about the standalone financial performance? Just IHCL's core operations on their own.
Yeah, the standalone numbers also paint a pretty strong picture. Full year standalone revenue was 5,145 crores. That's up a solid 12% year on year.
Okay.
And the standalone EBITDA margin was particularly healthy, 43.9%. That's an expansion of 260 basis points or 2.6 percentage points.
That's a very strong margin.
It is. And standalone PT, 1,413 crores, up a very respectable 29% year on year. So the core hotel brands, the core operations are definitely pulling their weight.
Good to see. Okay, now let's drill down into the hotel segment itself, but looking at the consolidated view again, how did that specific segment do?
Right, the hotel segment. Still their main engine, obviously. It's our consistent growth, too. Revenue was up 13% for both the full year FY25 and just Q4.
Okay.
And importantly, the EBITDA margin for the hotel segment improved. It hit 35.9% for the full year. That's up 2.2 percentage points. And 38.5% for Q4, which is up 2.3 percentage points. So again, you're seeing that efficiency improvement within the core hotel business itself.
And the key hotel metrics, like RevPAR and occupancy. For anyone listening, RevPAR is revenue per available room, a standard measure in the industry.
Good point. So domestically, their same-store hotels, the ones comparable year on year, saw RevPAR growth of 12% for the full year. That's strong. Reflects demand, reflects pricing power.
12% domestic RevPAR growth? Okay. And internationally?
International portfolio also did well. Average occupancy hit 73%. That's up quite a bit, 4.4 percentage points from the previous year.
Higher occupancy, good.
Yeah, and that helped drive a 7% RevPAR growth for the international properties.
Yeah.
And a really key point here, the pier in New York, which has been a focus.
Right, the iconic property.
Exactly. It actually turned EBITDA positive this financial year.
Oh, wow. That's a big milestone for them.
It really is.
Yeah.
Suggests the turnaround efforts there are paying off.
Definitely. Now, IHCL has been pretty active expanding its footprint. What's the story on portfolio growth?
Yeah, they've been busy. In FY25, their total portfolio reached 381 hotels. That includes 74 new hotel signings and 26 actual openings during the year.
74 signings, 26 openings. That's quite active.
It is. And what's interesting is that over 95% of those signings were capital light.
Ah, the capital light strategy. So more management contracts, franchising, less owning the actual buildings.
Precisely. It lets them grow faster, arguably, without tying up huge amounts of capital in real estate.
And the pipeline, what's coming down the track?
Looks pretty full. They have 134 hotels currently in the pipeline at various stages. So expect continued expansion.
Any specific brand milestones?
Yeah, they mentioned Ginger, their sort of value-focused brand, crossed the 100-hotel mark. And Vivanta, the upscale brand, hit 50-plus hotels. So growth across different market segments.
Okay, let's talk a bit more about that capital light strategy. How does it actually, impact the bottom line?
Well, it directly boosts certain revenue streams. Their management fee income, for example, grew by 20% in FY25.
20% just from fees.
Yeah, reached 562 crores. And that growth comes from a few places. Just having more managed rooms, that was up 11% net. Higher RevPAR at those managed hotels means higher fees. And they're also introducing new fee streams, like brand licensing.
So it's a profitable way to scale the brand presence.
Exactly. Less capital intensive, generates steady fee income.
Makes sense. Now, beyond the core hotels, they've been pushing these new businesses. How are those ventures doing?
They're doing, well, impressively, actually. This whole new business is vertical, which includes Ginger, Cumin, their food platform, Amon Stays and Trails Homestays, and the newly acquired Tree of Life Resorts.
Right.
Collectively delivered 40% revenue growth in FY25.
40% again, that's huge.
It is. Consolidated revenue from this segment hit 600 new crores, and the profit margin was a healthy 37%. It really shows these bets are starting to pay off, diversifying their income.
Let's break that down a little. Ginger, even though it's under new businesses, it's quite established now, right? How did it do specifically?
Yeah, Ginger enterprise revenue was strong at 675 crores. And the EBITDA margin, that's earnings before interest, taxes, depreciation, amortization, and rent, often used for leased properties.
Got it.
That margin was a very healthy 43%. And Ginger's portfolio is now 103 hotels, with another 30 in the pipeline. So continued growth there.
Okay. And the newer initiatives, Cumin and Amam.
Cumin's expanded quite a bit. Now has 72 outlets in various formats. They're leveraging IHCL's kitchens and culinary reputation there.
Makes sense.
And Amon Stays and Trails, the homestay brand, has grown its portfolio to 301 bungalows, with 132 actually operational now, tapping into that experiential travel trend.
Right, the demand for unique stays. And Tree of Life, the recent acquisition.
They took a majority stake. It adds 20 boutique resorts, 18 operational, again, diversifying into that leisure experiential space.
So these aren't just side projects anymore. They're becoming real contributors.
Seems that way, yes. Significant contributors.
Okay, switching gears slightly. What about investment? How much are they putting back into the business, both existing hotels and new ones?
They invested quite a bit in FY25. Over 1,000 crores in CapEx, capital expenditure.
Okay, and where did that money go?
Interestingly, it was split roughly 50-50. Half went to renovations, maintenance, and, importantly, digital initiatives. Keeping things fresh, improving the tech.
Crucial these days.
Absolutely. The other half went into greenfield projects, building new hotels.
And looking ahead to this year, FY26.
They plan to ramp it up slightly. Over 1,200 crores in CapEx plan for FY26. The focus remains on asset management, upgrades. They specifically mentioned the Taj brand getting upgrades, some selective greenfield projects, and doubling down on digital capabilities. They actually expect 60–65% of the FY26 CapEx to be on renovations and digital.
So a strong focus on maintaining quality and improving the tech infrastructure.
Exactly. Maintaining high standards, leveraging technology for efficiency and guest experience.
Speaking of guest experience and tech, loyalty programs are key too. How's the Tadanami program doing for IHCL?
It seems to be doing very well. They've hit 10 million members now.
10 million, wow.
Yeah, it's a substantial base. And crucially, the direct booking revenue coming from those members jumped 43% year on year.
43% increase in direct bookings from members.
Exceeding your over 2,200 crores. So the loyalty program is clearly driving valuable direct business and helping customer retention.
And customer satisfaction. Any metrics on that?
Yeah, they mentioned their Enterprise Net Promoter Score, or NPS. It increased to 74.
Which is generally considered quite strong, right?
Very strong, yes. Indicates high levels of customer satisfaction and loyalty across their brands.
Good sign. Okay, another important topic nowadays is sustainability, ESG. What's IHCL doing there? They have this Pathia framework, right?
That's right. Pathia is their ESG Plus framework. And they seem to be making real progress. 51 of their hotels are now using clean energy sources.
51, yeah.
And 13 hotels are operating on 100% renewable energy. That's through a mix of on-site solar, for instance, and buying renewable power off-site.
That's quite significant.
It is. And IHCL standalone, which is about 2/3 of their consolidated hotel revenue, they recorded using 54% renewable energy overall.
Over half, okay.
Yeah. Plus, they've installed 64 water bottling plants to cut down on single-use plastic. And they've achieved 50% water recycling across their operations. So it seems like a pretty comprehensive approach.
Definitely seems like they're taking it seriously. Okay, let's look forward now. What's the outlook for the current financial year, FY26? What are they expecting?
They're sounding quite confident, actually, projecting double-digit revenue growth for FY26.
Double-digit again. What's driving that optimism?
A few things. Strong domestic demand for travel is expected to continue. There's potential for international tourist arrivals to pick up more steam. And, interestingly, they mentioned a high number of auspicious wedding dates this year.
Ah, the wedding season factor.
Exactly. That's big business for hotels like theirs. Plus, they started the year strong. April 2025 consolidated revenue was apparently up around 17% year on year, and they have strong bookings already for Q1.
Good momentum then. And financially, are they prepared for bumps in the road?
Seems so. They have a healthy liquidity position, about 3,073 crores in cash reserves. They mentioned using this to handle potential headwinds, but also maybe for consolidation opportunities if they arise.
Makes sense to have that buffer. And expansion plans for FY26. More openings.
Yeah, the target is to open over 30 new hotels in FY26. 3 of those will be on their own balance sheet, meaning owned properties, not managed or franchised.
30 openings planned. Busy year ahead. Okay, let's dig into a couple of specific projects they mentioned. The bandstand project in Mumbai, that sounds like a big one.
Potentially, yes. It's a prestigious location. They plan to develop it through a subsidiary, currently wholly owned. They sound optimistic about getting approvals sorted out.
Like road access and environmental clearance.
Exactly.
Yeah.
They mentioned a positive movement expected on road connectivity and good progress on the CRZ Coastal Regulation Zone approval, hopefully in the next few weeks. They've also applied to build taller, up to 165 meters from the currently approved 145. So, quite ambitious. If things go well, construction could even start towards the end of this calendar year.
So one to watch for future growth, definitely. What about greenfield development more broadly? Building from scratch, are they keen on that?
They seem cautious, selective. They basically said pure greenfield, buying land, building everything might not offer great returns, great IRRs at current rates.
Okay, so what's the alternative?
Focus is more on getting land leases at good rates or using land they already own. That makes more financial sense, apparently.
But not ruling out greenfield completely.
No, not completely. They see opportunities in Tier 2 and 3 cities or new markets like Ekta Nagar. They think projects there could have quicker payback times, maybe lower land costs, good growth potential.
So strategic greenfield, not just anywhere.
That seems to be the approach. Prudent.
Got it. Let's talk about direct bookings. We know it's more profitable for hotels. What's IHCL doing to get more people booking directly on their own website?
They are definitely focused on it. They managed to increase the share of bookings from their own website by 1 percentage point in FY25, reaching 15%.
15% direct online. Okay. How are they trying to push that higher?
Well, they've relaunched the websites for Taj and Aman, better user experience, more features, and they have this plan to launch new, supposedly best-in-class websites every 6 weeks for their other brands.
Every 6 weeks? That's ambitious.
It is. And they're using digital marketing and the Tata Neu platform to drive traffic to these sites. The incentive is clear. They estimate saving around €700 to €800 per booking in commissions, especially for upscale and mid-scale, by getting that direct business.
That adds up quickly.
It really does.
Okay, there was also something about margins at Tashes, the air catering JV. What was the issue there?
Yeah, the margin looked lower in the quarter. It was mainly due to an accounting change for a levy in new contracts.
An accounting change.
Yeah, this levy now apparently flows through both revenue and the cost line. Sometimes there's even a levy on the levy, making it complex.
Okay, so it hits the margin percentage.
Right. They estimate it could potentially impact the FY26 margin by about 1%. But the flip side is, because the levy is now in the revenue number, it could actually help drive top-line revenue growth.
Ah, so a bit of a technical accounting impact, not necessarily a fundamental business issue.
That seems to be the gist of it. Lower reported margin percentage, but potentially higher reported revenue.
Got it. And quickly, international markets, US and UK, how are things looking there?
Sounding more optimistic, particularly about the U.S. They mentioned San Francisco's recovery occupancy back to previous levels, rates going up. April was apparently very good there.
Good news for San Francisco and New York, the Pierre.
We mentioned it turned EBITDA positive, which is huge. They expect that positive trend to continue, so signs of a turnaround in those key international spots.
Excellent. And lastly, any comments on general demand trends, booking patterns?
Yeah, they noted booking windows are generally getting shorter, people booking closer to their travel dates.
Except for holidays, I guess.
Exactly, except for peak seasons. Growth is mainly coming from higher average room rates, ARR.
Okay. And regional performance.
Goa was flat, but apparently off a very high base from last year. But the major cities, Mumbai, Delhi, NCR, Bengaluru, Chennai, also Rajasthan, Hyderabad, Kolkata, all showed strong RevPAR growth in Q4. So solid demand in key domestic markets.
Okay, great. So let's try and wrap this up. What are the main takeaways from this deep dive into IHCL's results?
Well, I mean, the headline is definitely the continued strong performance. 12 record quarters in a row is impressive by any measure. Their strategy seems to be working, the capital light expansion, growing those new businesses significantly, managing their existing assets well.
Yeah, the numbers across the board, revenue, profit margins look pretty robust.
They do. And management sounds very optimistic about the year ahead, FY26. They're banking on strong domestic demand, maybe some help from international travel recovery, and a good wedding season.
And they seem financially well positioned with that cash reserve, too.
Exactly. Ready for opportunities or challenges.
So a positive story overall. But maybe a final thought for you, our listener, to chew on. IHCL's had this amazing run. They have ambitious plans. But the hospitality world changes fast, right?
It does. Competition's always there. Guest preferences evolve.
So the question really is, how does IHCL keep innovating? How do they keep creating those unique experiences to stay ahead, not just maintain, but really strengthen their lead in the long run? That's something to keep an eye on as you watch the sector.
Absolutely. Strategic agility will be key.
Yeah.
And if you found this helpful, if you want us to dig deeper into other parts of hospitality or even revisit IHCL later on.
Yeah, just let us know. We're always keen to tailor these deep dives to what you find interesting.
Definitely. Let us know your thoughts.